Hi everyone, and welcome to the Buffett and Beyond Stock Selection Strategies. And remember, if you want to live on the beach like Jimmy Buffett, you've got to learn how to invest like Warren Buffett. And we will teach you how to construct your own portfolio through the use of our podcasts, our daily market letters, our weekly video stock analysis, and our proprietary computer program. Hi folks, this is your host, Dr. Joseph Belmonte, along with Debbie, and that's Debbie with a Y, and all the questions she has from our listeners out there in investment land. And before we get to our podcast today, if you want a free sample of all our materials, just go to our website, buffettandbeyond.com, and sign up for our 30-day free trial, which contains all of our information along with access to our computer program. And remember, it's free for 30 days. So yes, we will teach you how to invest like Warren, but you've got to figure out how to live like Jimmy all by yourself. And just before we get to our stock questions sent in or called in by your listeners, I want you to understand that we use a method of comparability called clean surplus. Clean surplus is an accounting and finance model that allows us to compare stock to each other regardless of their industry. And clean stands for comparable and surplus stands for profits. And clean surplus is the only, and folks, I repeat, the only researched and tested method of comparability that allows us to compare stocks in the exact same way that we compare the returns given to us by banks. And folks, it is this simple. If Bank A is giving us a return of 10%, while Bank B is giving us a return of 5%, then we would certainly invest in Bank A. Now, really, isn't that bank interest a return on equity? Yes, it is, and that's how we compare stocks. So the bottom line key to building a better than average performing portfolio is to select stocks that have clean surplus ROEs, return on equities, higher than the average stock in the S&P 500 index, which is the benchmark for the investing world. Now remember that over any 1 year period, 75% of mutual fund portfolio managers cannot outperform this index, and over any 10-year period, 96% of mutual fund portfolio managers cannot outperform the S&P 500 index. This means that just 4% of portfolio managers can outperform this index over time. And folks, the Buffett and Beyond method of stock selection puts us in that 4% category. Buffett and Beyond proudly presents to you the good, the bad, and the ugly. And remember, folks, the good stocks should be in our portfolios, the bad stocks should be in somebody else's portfolios, and the ugly stocks should be in nobody's portfolios. Debbie, what's our very first question?
Hello, JB, and hello, everybody. This week we're going over two stocks that were requested by our listeners over the past several days. And we have two stocks from the same industry. And along with these two stocks comes the question that you've been asked for the past 20 years. Then after we go over these two stocks, we were asked a question that everyone wants to know the answer to, and that is, how can you tell which stock will perform better in price than another stock? But first, John wants to know about Home Depot. Is it making money, and should it be in a growth portfolio?
All right, let's look at Home Depot, and the first thing that we want to look at is that clean surplus return on equity. And folks, think of your bank account. When I use the clean surplus return on equity, we are able to compare stocks the same way that we compare the interest that's being paid to us from one bank relative to another. So think about the average stock out there. Think about the average bank paying us about 14.5% or a return on our equity, or the interest that's being paid on our bank account of 14.5%, which is the average bank. Now, Home Depot has a return on equity, a clean surplus return on equity of about 22.9%. So right there, folks, it's telling us that this stock is doing something right and that it's making almost twice as much as the average stock out there. And then the other thing that we want to look at is, does it have a lot of debt? And with Buffett, his rule of thumb is that if a company can take all of its earnings and pay it back over 5 years or less, then the stock does not have too much debt. And in the case of Home Depot, it can take its earnings and pay off its debt in just 2.3 years. So we don't have to worry about the debt at all. And the recent dividend is 2.3%. Now, we like to see no dividend in a pure growth stock, but in this case, Home Depot's been around. It's turned turned into a cash cow as well as growing, because it's taking what it's making and putting about 55% of what it's making back into the company in order to grow. So it's still a growth company, but that growth is slowing down, and it's taking the extra money and paying it out in the form of dividend. But the clean surplus return on equity, the stock is paying 22.9% projected for 2019, and we would expect this stock to outperform the market averages by almost double. And then when we look at the past 5 years, a chart of Home Depot versus the S&P 500, we see the S&P 500 with a return of a hair under 75%, while Home Depot is returning 175%. So yes, this stock is definitely a winner, folks.
Well, keeping within the same industry, Bob says he would rather shop in Lowe's because to him it's more convenient. He noticed that both Lowe's and Home Depot are very similar, but he wanted to know which one of these companies should he buy stock in.
Well, let us take a look at Lowe's, and remember, the average stock or the average bank out there is paying about 14.5%. And when we look at Lowe's clean surplus return on equity, think of your bank account, we're looking at 18.5%. So it is way above the average stock in the S&P 500. And then when we look at the debt, we see the debt is within range. It can pay back all of its debt within 5 years. And the recent dividend is about 2%. So when we look at Lowe's, we look at that clean surplus return on equity of 18.5%, and we say this is a better than average stock. Now remember, we're comparing it to Home Depot, which is paying 22.5% clean surplus ROE, that is. So we like Home Depot a little bit better than Lowe's, but still, Lowe's is a better than average stock. And we would expect it to outperform the S&P over the past 5 years and going into the future. So when we look at a chart of Lowe's versus the S&P 500 over the past 5 years, remember the S&P 500 is paying just a hair under 75% over the past 5 years. And we can see that the S&P 500 has returned a hair under 75% over the past 5 years, and Lowe's is up about 120, almost 130% over the past 5 years, so almost double the S&P 500. Yes, we have another good stock here, folks.
Wee-hoo again. And our next listener wasn't asking about a particular stock. He just wanted to know in general, can you determine how much an individual stock will appreciate over, say, the next year or so? And really, how can you tell?
Yeah, and the answer is that we look at that clean surplus ROE, and in a normal market year of a return of about 10 or 12%, we would expect these stocks that have ROEs, a clean surplus ROE, above 14.5% to outperform. And there is a nice correlation between that clean surplus ROE and the future appreciation of a stock. And folks, nobody knows that, but that's the doctoral dissertation research work that I did. And if you want to see that dissertation, I can certainly send it to you. Just go to our website, buffettandbeyond.com, and where it says contact us, just tell me that you want to see that dissertation. Or better yet, read the book, because the book is written in English where the dissertation is written in academic terminology. So we went over O'Reilly Auto this week for our stock analysis of the week to our subscribers and those of you who are receiving our 30-day free trial subscription. And O'Reilly Auto had a clean surplus return on equity of 19%. So it's a little under, it's about 3% under that of Home Depot. But O'Reilly is taking all of the money it's making and putting it back into the company in order to grow. So even though O'Reilly has an ROE lower than that of Home Depot, it is putting 100% of its money, O'Reilly I'm talking about, 100% of its money back into the company to grow, where Home Depot is taking about 60%, 65% of the money it's making and putting it back into the company to grow, and the rest it's paying out in the form of a dividend. So when we normalize the clean surplus return on equity of O'Reilly, we see that we would think that O'Reilly and Home Depot would grow about the same in price appreciation, I'm talking about now. Lowe's would be third, but all three of these stocks would be above the S&P 500, so they're all candidates for your portfolio, folks. And when we look at those ROEs of Lowe's, O'Reilly, and Home Depot, again, Lowe's had an ROE of 18.5%, O'Reilly 19%, Home Depot 22.9%. So if we were just looking at those clean surplus ROEs, we would say Home Depot would outperform O'Reilly and Lowe's. However, we know Lowe's and Home Depot are paying some of the money they're earning back to the investors in the form of dividends, where O'Reilly is putting all of its money back into the company to grow. So O'Reilly should be up there vying for the number one spot with Home Depot. And when we look at a chart over the past 5 years of all three stocks, we see O'Reilly and Home Depot are tied for first place at 175% return over 5 years. And Lowe's with about 130% return, all well above and all almost doubling, or at least doubling, the S&P 500, which is returning a little bit under 75%. So the answer to that question is, you look at that clean surplus ROE, which we have in our computer program, folks, of about 800 stocks, and you can see which stocks will very, very probably outperform the other stocks and outperform the S&P 500 going forward.
Oh, well, JB, we've answered questions not only about individual stocks, but you answered a very important question about a stock's anticipated appreciation in both value and price. So for you listeners out there, we're here to answer questions not only about individual stocks, but also about the market in general. So keep those questions coming, and who knows, we may even answer a question or two that you didn't even know you had. Well, JB, that's about it.
Okay, we're out of time. But folks, you want a 30-day free trial subscription to that computer program so you can look through all those 800 stocks yourself and buy the stocks that we suggest, and you receive our portfolio of 30 stocks for 2018. Just go to our website, buffettandbeyond.com, all one word, and Buffett is spelled with 2 F's and 2 T's, so it's BuffettandBeyond, buffettandbeyond.com. Okay, folks, we had a very good day today.
And tomorrow will be even better.
All right, folks, we'll see you next time.
Bye, everyone.
And remember, folks, if you want to live on the beach like Jimmy Buffett, you've got to learn how to invest like Warren Buffett. We've had a good week, folks, and here's hoping that next week will be even better. You have a safe weekend, and we will see you next time.